Hi, welcome to T-Minus Retirement. My name is Dustin Watts. I have my co-host today with me, Brian Owen.
Hello, hello.
Today is March 27th. We're just about the end of the quarter, and to no surprise, as we've gotten a couple weeks in here, it's been a volatile month. We have a war in Iran going on that's really been capturing the headlines. I thought this was the perfect time for us to take a step back and review just some key important things as investors, just to kind of keep in the back of our mind, and also to review how this time maybe relates to history. And I think that really can help maybe ease some of the anxiety that people are feeling right now.
People feeling anxious? Oh, no, not right now.
Yeah, I mean, anytime bombs start flying and the Strait of Hormuz is in the news, I think there's some anxiety. Honestly, what's probably really causing anxiety is gas here in California going from, I don't know, $4s to, $6.50 in what seems like 2 weeks. But, we certainly understand the anxiety and we sympathize with that. I think nobody wants war to be going on. We're all in this situation where, we have our investment thesis out there for what we think is going to happen from an economic standpoint throughout the year, how our investments are situated, and then we get a complete curveball out of left field, right, with a war that really nobody was planning for, and that causes a lot of angst. And certainly, it's something to pay attention to. But I really wanted to take a step back, kind of maybe turn off the news for a minute and just look at some stats, and then also just review some good investor, what's the term I'm looking for? Just some good anecdotes to keep in mind while we're going through these volatile times. So
yeah,
we'll start off with looking at some history, if you don't mind, Brian.
Yeah, let's do that. I'm going to switch it over and we're going to take a look at the screen here.
So I really like to show this chart, and we're going to get to another chart here in a second. But what we're looking at here is what percent markets are off their highs, okay? This chart goes back to 2010. The S&P is going to be represented in gold, the NASDAQ in green, the Dow in purple. And the reason that I show this is because it's just a reminder, and this is just a short chart, relatively speaking, but it's a reminder that we have these periods all the time. I mean, almost every year, and it's always for some different reason, and it's always the end of the world, and it's always, the start of the next crash. And, if you read every news headline, and, do some of those situations certainly turn into bear markets? They have. I mean, on this screen here, there's been bear markets during this time. But I just find it interesting that, we can go back to like 2011. We had about a 15% pullback in the markets. 2012, we had some times of maybe some lower volatility here. 2016, if you remember Brexit, Trump first administration was elected. Markets crashed that night that Trump was elected. There was a whole sorts of stuff going on here. Markets have recovered since then. That was about another, 15 to 20%, drawdown here. 2018, we had the Fed raising rates. The market crashed into the end of the year at 2018. It was down 20% in like a quarter. This big one here, this is COVID, right? Look how quickly that happened. The market at the low was down 37% off the highs. That just was like a flash crash. Obviously, that really was something drop. Different.
Oh yeah.
Yeah, I mean, nobody alive had seen anything like that. I'd like to remind people. I think we've gotten maybe a couple years removed from this, but For those of us who've been investing for more than 2 years, literally 2022, we had a full-blown bear market, all due to interest rates, due to high inflation. I mean, does anybody? I'm sure people remember that. Yet
Oh yeah.
I feel like people have really lost sight of that. They act like we've gone nothing but straight up for the last decade, which, again, if you kind of look at this chart, that couldn't be further from the truth.
Yeah.
Right here, this last pretty good spike downward, that was April of last year. I'll remind people that last year ended up a positive year in the markets. Now, again, we're right here, all the way to the right of this chart. It's March 27th. This data is hot off the press. I just generated this chart through Y charts here before the video, after the market had closed, and this is where we're at. The Dow and the Nasdaq are in correction territory off the highs, and 10%, 12%, and down 8.74% for the S&P. Now, does that mean that we completely change our investment strategy because we're in a drawdown? I would argue no. And I think the next chart that I want to show here really reflects why that is. And if you've been watching the channel, you know that this is one of my favorite charts, because this shows declines back to 1980, so even farther than the one we were just looking at. And from left to right, you have 1980, you have the red dot, that's the intra-year decline, and the gray bar, up or down, is where the S&P 500 ended that particular year. So what do we take from that, Brian? I would say that the biggest thing to take is every single year we have some type of decline. Sometimes they're 7%, sometimes they're 34%, sometimes they're 49%. I mean, that's obviously 08.
Yeah.
That was, I would argue we're not in a financial crisis. I mean, at least nothing is pointing to that quite yet, despite some of the YouTube videos I've seen lately on, pointing to that. But, if we just even look at the period that I was just showing on the chart, 2010, that starts right here.
Yeah.
We have double-digit declines almost every year. And in fact, since we have all this data, we can see that the average decline per year is 14.2%. But the average return, despite of that, the annualized return over this 25-year period, it's in the fine print here, but this is on the S&P, it's 10.7%. So annualizing 10.7% return while experiencing almost every year some type of double-digit decline, 14.2 is the average. 75% of the time, if you look at my cursor here, 35 out of the 46 years, markets are positive, 75% roughly. So I just like to keep that in mind, because every year the market declines for some reason. I mean, and every year, that's not to say that you have to discount, every single one, but it is to say that this is something, if you want to be an equity investor, that you're going to deal with over time. And I just think it's smart to look back upon history and say, okay, should I have panicked and completely changed my investment strategy or sold out of everything every single one of these times? Well, history and the data shows us that if you were to have done that, probably 90+% of the time there, you would have sold out and the market would have ended up higher that year.
Yep.
So you're kind of always chasing your tail, so to speak.
Trying to chase those returns.
Well, and that goes into, I'll chart off here.
Sure.
That really goes into something I just wanted to kind of bring up, and I think is important when we do have market volatility. I think you really need to ask yourself, what kind of investor are you? Are you a day trader that's in and out of the markets? Then you probably love this environment, first of all. But are you a long-term investor? The pattern that I see with some people is you want to be a long-term investor when the market's going up, and then you want to be a trader anytime the market, has a very normal, like the chart I just showed, a very normal decline. And again, I say it's a normal decline. It doesn't mean that all of those declines happen for some reason, right? And at the time, it was across the news. It was on every banner, on every website you go on. And may I remind you, 75% of the time on that chart that we just looked at, we've been at war. Okay. I'm 35 years old. We've been at war my entire life.
Yep.
The market, is just, there's going to be periods where the market really obsesses about, how the war is going to transpire, and then it will move on at some point, regardless of what happens. We all hope that there's a quick end to this. I have no insight to that. I'm not going to play a military expert, but the whole thing is, I think you really need to just take a step back if you find yourself all of a sudden extremely anxious and wanting to change your entire investment strategy because we're down in correction territory from an all-time high, just a couple months ago. You need to ask yourself, okay, who am I? Why am I investing? What am I investing for? Has any of that changed? Maybe it has. I don't know. But I would say for the majority of people, it hasn't. Don't act like don't become a trader all of a sudden anytime the market has volatility, because the one thing that I will give you caution on is it's very easy to sell out of the market and go to cash and say, oh, I'm gonna get back in when the dust settles and when things clear. Well, newsflash, typically markets don't bottom on the war being over and everybody's, singing Kumbaya again. Yeah. Typically the markets bottoms on some of the worst news. And, this is a chart I don't have. Maybe I'll throw it in there after the fact, Brian.
Yeah, we could find it.
It's so important to not miss those big return days, because regardless if you're in the market, on the big down days, if you miss the big up days, it drastically reduces your return. And that's the danger of trying to trade markets like this when they're trading on headlines. That's a big risk. If you are out of the market one day and you don't get back in when the market has some big pop. And again, almost all those big up days are clustered very closely to big down days. That's just where volatility spikes, and volatility goes both ways.
You mean we don't get a nice little welcome message ramp up like, here guys, it's coming?
No, they typically don't send out a newsletter and ring a bell telling you that the coast is clear.
Yeah.
All the hedge funds and everything else have already loaded up and are long again.
Yeah.
But now in the news it seems like maybe somebody's getting some information and trading on that, but that's probably for another video. That's nothing new, by the way.
Yeah, it's true. Well, while you're on that subject about what type of investor saver are you, consider for a moment some of the headlines that are filling the media right now. Like you said in the beginning, here we are, March 27th, 2026. And, there's fears about obviously the war going on in the Middle East. There's fears about inflation. There's fears about what's the Federal Reserve going to do when it comes to interest rates. There's all kinds of things that instigate fears and prompt, activity to sell. And, it's obvious. You can watch, anybody can turn on CNBC or, another source and be able to see these things. But it's important to know, just because all of a sudden the headlines are saying that, there's a lot of selling activity, doesn't mean that we automatically want to go and do the same thing and, flush our, investable funds into something safe, like a savings account or money market.
No, that's true. You notice how too the people on TV, they never tell you when they got back in or what have you. You just have to be careful about trying to play that game.
Yeah.
99% of the time, it goes against you. And again, that's why I say you have to just ask yourself who you are. Are you investing? Are you trading? And maybe you can do a little bit of both of that, but from going one to the other, I think is dangerous. But that brings up my second point, and I think in times like this, you have to really ask yourself, where are you going? So first rule is
Yeah.
ask yourself who you are, and investor or trader. And then the second rule is like ask yourself where you're going, or what is your actual time horizon for needing all these funds. And again, everybody's answer to that is different. And even if you're retiring tomorrow, you don't withdraw all of your funds the day that you retire. You need that money invested for 20 or 30 years. So you just have to be careful about making a drastic decision to all of your money, and risk potentially, you know, having a blunder and not getting back into the market, because that happens a lot. You get out of the market and then you're always so scared to ever get back in that a couple of years goes by, and you're just kind of watching the market do whatever it's going to do. But I just think that you really need to ask yourself where you're going. When are you going to need access to even a portion of these funds? If you're going to need access to a portion of them, okay, well that's if you've been working with us, that's why we structure things where, okay, you're going to have cash reserves, you're going to have some fixed income, you're going to have equities.
Yeah.
That gives you optionality too. Okay, maybe we don't pull from your equities while the market's in a drawdown. Maybe we take from your bonds, or maybe you have plenty of cash that can get you through the next 1 year. I don't know how long any of this stuff is going to go on, but you just have to you have to kind of think through those things and just remind yourself, okay, who am I? Where am I going? Am I situated in a way to get me through whatever this length of period is? And again, that doesn't mean that the market's not going to go down on Monday or Tuesday, but you just kind of have to live through some of these fluctuations, thinking that you're just going to get all the upside and none of these drawdowns. I mean, I can't think of a nice word to say, but it's comical at best. You're investing, you're in it for, all of us are in it for the longer term, big picture. That's how you get the 10.7 annualized rate of return over the 46 years.
Yeah.
You don't get that by only being invested in the up and none of the down.
Yeah.
If you can do that, then there's somebody on Wall Street that you're missing your payday. But
yeah,
you got to remember it's a little harder than it sounds, and you're also trading against algorithmic trading that has got it down pretty good.
Yeah, and it's helpful at this point when we know that, for example, investing for the long run, like what we do or other advisors do, it's not the same thing as gambling funds, and if I to kind of visualize what you're talking about, if I decide, hey, I'm going to take $10 worth of quarters and go into the casino one day, and I'm going to take my chances on 20 different machines to see if one of them pays me out, but after burning through half that bucket of quarters, I don't win anything, and I get frustrated and walk out and say, like, okay, well, I'm not having any luck, so I'm just gonna get out of it and take my my $5 worth of quarters back with me, and then come back the next day and see if I have any luck that day. I'm starting the day already down, and I'm my odds of winning are working against me because I'm working with less than I started with. And so it's not to say that that's identical to it's not identical at all to investing, but it's somewhat, when we take that approach where it's like, hey, the markets are a little crazy, I need to go out and get into cash, and then I'll try to find the right time to get back in. We almost start to take this gambler's mentality where it's like, hey, you know what, I want to try to play when it's more favorable, but and then in the meantime, on the investing side, not the gambling side, on the investing side, by not being invested for the long haul, I'm missing my days, my opportunities where, like you're talking about, Dustin, those gains tend to surprise us and pop when things pop back.
No, that's a good analogy, because again, it's probably having some conviction in what you own helps you too. It's like, okay,
Mm-hmm.
I know what is in my portfolio. I know the types of companies that and funds that I'm using has quality companies in it. They're not going away despite of whatever's going on in the Middle East. Okay, is the multiple going to come down a little bit for some period of time because there's volatility? I mean, possibly, but that doesn't convey that you're gambling with
Yeah.
anything. Being invested over time is where you almost, if anything, you almost guarantee yourself to start to win on some of this.
Yeah.
I mean, we have the data that shows, the more time you have into the market, the more your returns are positive, and you get to these average type of, annualized returns. That's really the name of the game if you're a long-term investor investing for retirement. And that's of course who we deal with. We're not this isn't a trading channel by any
Yeah.
means, but you know, I just thought it was important to maybe discuss a couple of these big picture items, because certainly if you're glued to the news all day, you kind of go a little crazy, a little stir crazy, and you really start to question a lot of things. And there's a saying that in bear markets, stocks return to their rightful owners. I don't know, was that Warren Buffett that said that? Something like that. But it's really true,
Yeah.
because if you're an investor, you take some of the bad with the good, and over time, and you invest in good companies, you get a lot more good on the other side of it. Right now, markets are volatile. You just need to really keep some of these things in mind and not, derail your entire plan.
Yeah, and it's a good point, and to kind of go along with what you said there, it's really there is always somebody else on the other side of that trade. So stocks do return to their rightful owners, I suppose. But along with what you're saying there, too, Dustin, we had realized that, hey, we're being invested for the long haul, and it doesn't. When we have seasons where the markets are down because of whether it's geopolitical activity, whether it's inflation, whether it's other concerns, numerous concerns, there is an overall plan that should be in place. And being invested, even when the markets are down, doesn't throw off your overall plan if it's diversified properly. And that's where it would be a good encouragement. Talk with your financial advisor, talk with your financial planner. If you're invested and you're wanting to make sure that everything lines up with your plan, even in spite of what's going on. I mean, that's good, sound wisdom, and that's where you want to not just necessarily trust in your own instincts, but seek the counsel of other professionals and see if it makes sense and if it's lined up with your overall goals and plan in life.
No, that's right. I mean, anytime a financial plan is put together and there's a model that's assessed, I guarantee you that it's not, we're not planning for an up year every single year in the market when we're saying that, hey, based upon your financial plan, things are looking good. You're going to be able to achieve these goals, spend X, in retirement. We take into account that there's going to be negative returning years. There will be, in the future, we don't know. We have no way of knowing if that's this year, next year, or 5 years from now. But you need to kind of fall back, like Brian says, on that financial plan, on the people around you, to say, okay, I have the means to get through the volatility that we're currently experiencing. Mm-hmm. We've had a lot more, I would say, scary times, certainly in the last 46 years that I was showing you on the screen there. A lot more, over that time than maybe this current situation. But I guess time will tell.
Yep. We do see too that markets tend to bounce back faster than they used to.
Well, yeah. There's just so much data, news and data is just absorbed and processed so much quicker than it was in 1980. Markets are moving more. They're a little more volatile.
Yeah. Dustin, that was really helpful, and I appreciate you sharing those charts and the information, the history with us, and kind of some questions for us to kind of step back and ask ourselves in considering. And so, yeah, like you said, I hope this is helpful, and we hope this is helpful, and we hope that it'll be a benefit to you. And like I was saying too, if you're working with a financial planning professional, and you have questions, reach out to them, talk to them. If you don't have one, and you'd like to reach out to us, the information's in our in the post information on the video. You can look at the details on how to get in touch with us. But nonetheless, stay invested, stick it out. It's these things move in cycles, and it's, even though we're down right now, we're going to pick back up.
What is the other saying? The juice is worth the squeeze.
That's right. Always.
All right. Well, appreciate your time. If you like the video, please like, subscribe. We'll see you in the next one. Take care.
We'll see you in the next.